Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings, and believe me, sometimes that's a real challenge. Today we are diving into the latest report from WidFit Inc., and I have to say, this one's a bit of a head scratcher, like trying to assemble furniture without the instructions. We will see what challenges and questionable choices they might be making. WidFit Inc. just filed their Form 10Q for the period ending September of last year. Basically, it is a quarterly check-in with the Securities and Exchange Commission, the SEC. Companies have to show how they're doing financially if anything big happened and what they see coming down the road. So who exactly is WidFit? They are a Nevada corporation, meaning that's where they are legally set up, even though their main office is actually in Israel. The core of their business plan revolves around an internet browser. But not just any browser. They are building a browser designed to give you control over your data, either keeping it private or getting rewarded for sharing it. It's an ambitious idea, especially in a market dominated by giants like Google Chrome and Safari. Now, before we get too deep, there is something called a forward-looking statement. Companies have to make these statements to discuss possible future outcomes that might occur and to protect themselves from any potential lawsuits. Keep in mind that these are basically educated guesses and actual results could be different. We should not take these future expectations as a guarantee of any kind. Alright, let's dive into the numbers. As of September last year, WidFit's balance sheet shows total assets of just over $40,000, not exactly a fortune, and a large part of that is cash held in trust. Now compare that to the end of the previous year, where the company held about $21,000. You can see they are holding a bit more cash. It is not uncommon for a young business that is starting to have low funds. The important thing is to know where the money is being spent. Looking at their debts or liabilities, they have got about $11,000 in short-term debts. That includes money they owe to suppliers and notably about $9,250 they owe to a related party, likely someone high up in the company. What I mean by that is that they need to pay their debts to operate smoothly. A lot of times, not doing so can trigger big problems down the road. Now, onto the good news, stockholders' equity. This is what's left over for the owners after you subtract all the debts from the assets. WidFit's got about $28,800 in equity. This is the amount that remains for shareholders, which means this reflects the value and the investments into the business. If you remember the total amount of the assets was $40,000, this amount makes sense. Let's talk about revenue, or well, the lack thereof. For both the 3 and 9-month periods ended September of last year and the previous year, WidFit reported zero revenue. Which of course means no money coming into the business, and the company is relying on other sources of revenue to fund its business, such as investors and loans. So what is money being spent on? Operating expenses. In the 9 months ended September of last year, they spent about $7,500. A large part of that is professional fees, legal, accounting, things like that, and then general admin costs. Because the revenue is zero, that means a net loss of around $7,500 for that period. That translates to a loss per share of practically zero, which makes sense since there are millions of shares out there. It would not be uncommon for a newer company to have a zero revenue, so I would not be alarmed. Cash flow is the lifeblood of any company. WidFit's statement of cash flows shows that, for the 9 months ended September of last year, they used about $5,500 in operating activities. But thankfully, they got a boost from financing activities, bringing in $24,500, mainly from issuing more stock. So overall, their cash position increased during that time. But these types of funding for the business would be unlikely to be consistent. Alright, let's break down some of the accounting jargon. These are basically the rules and methods a company uses to keep track of its money. They cover things like how they handle cash, how they deal with taxes, and how they recognize revenue when money comes in. It's important to understand these policies because they can affect how the financial results look. As of September of last year, WidFit can issue up to 75 million shares of stock. As of the end of September last year, about 7.8 million shares were out there. Basically, they keep issuing more shares to get cash to cover their expenses. In December, WidFit repaid $2,750 to the director against his related party dues, showing effort to clear debt. Management is required to provide an overview of the company's situation. They talk about where the numbers come from, what the key trends are, and what they expect to happen in the future. And this is all forward-looking, as said before, so we should not trust it too much since they are speculations. They also touch on COVID-19 and its potential impact. Companies were including this information when they filed, and still do because it has a lasting impact on how business is being done, on the economy, and of course, on people's health. In conclusion, the virus could have a negative effect on the business. Now let's talk about the risks involved. The company is upfront that they have a very short operating history. The business may not always be successful in its business plans and have possible delays in the exploration of their browser. Also, they may have cost overruns, such as prices in costs and services. All of this leads back to the importance of having a diversified set of plans. Here, the top executives say how they are handling the processes that ensure the details presented to the SEC are true and accurate. WidFit reported that their internal controls over financial reporting were not effective as of September last year. This means that they recognize they have some work to do to improve their financial reporting. The company said they are not currently in any legal battles. If they were, it might affect the business's financials. Finally, the report ends with signatures from the company's top executives who are swearing that everything in the report is true to the best of their knowledge. Now, let's step back and look at the bigger picture. WidFit has an interesting idea. A web browser that gives users control over their data, but the road ahead looks very difficult. The company faces a lot of challenges, including competition, no revenue, and the need to find more cash to keep going. While they were able to increase cash from investors in the past few months, it might be difficult to rely on investors to continue contributing. One of the biggest concerns is their lack of revenue. To succeed, they need to start bringing in money, either through advertising partnerships, subscriptions, or some other way. The browser market is dominated by huge companies like Google and Apple, so WidFit needs to offer something really special to stand out. I would recommend to build partnerships with some smaller companies to bring revenue as well as market power. Bottom line, WidFit has a long way to go. It will be interesting to see if they can turn their vision into reality or be another startup that is long forgotten. Thanks for watching. If you enjoyed this breakdown, please like, subscribe, and leave a comment below. Let me know what company you want me to decode next time.